so popular to talk about because of Y'all Street and also on the downside because of the infrastructure issues. How's it feeling right now as the lawmakers return home, reportedly, to vote on some aid?
Well, I'll tell you, it feels a little bit like you're walking in the dark and you're kind of looking around, trying to see where everything is, because the amount of uncertainty that we're seeing throughout the markets, I think, is what's causing most of the issues. Clearly, there's a lot of exuberance, a lot of excitement. Tesla did that huge deal with Samsung that'll buy $16 billion in chips, for the next 10 years or so. Elon got a big pay package to keep him at Tesla, and Tesla being an Austin-based company. There's a lot of things that are really fueling the excitement. We're starting to see the inventory really absorb. Austin actually leads the country in net absorption. And so there's a lot of other issues that I think are making people uncomfortable with where rates are. The Jackson Hole summit that I think will be the chairman's most important speech maybe of his entire tenure. Right?
That's a big call. Why do you say that? Because a lot of folks are saying he's not going to rock the boat too much.
Well, I think it's the most important because we have a few things that are happening here. One is the president pressuring the chairman to lower rates. Let's talk about that for a second. If we lower the Fed rate from 4% down to 0, well, what's going to happen on the other end with tariff inflation pressure is the 10-year is going to go up. So having a short-term solution that sounds real nice, but the real homeowners and the mortgages with $10 trillion of mortgages that are based on the 30-year, the benchmark is the 10-year Treasury. So really bringing those rates down with the tariff pressure is a little bit of a difficult slot to navigate. Clearly, inflation was high. The Fed had to give some medicine, but now consumers are choking on that medicine. So it's one of those situations where both options have their complexities. And I think actually what's happening with Freddie Mac and Fannie Mae in terms of this secondary offering, so to speak, could be very interesting, because if you bring the $191 billion that we put in initially, has been paid back in dividends several times over. So if it does come and allows global investors to participate, I think that liquidity will actually help temper where the 30-year mortgages are, which will be desperate relief to the affordability that's in the housing. So it's one of those situations where you pull one thing, it's causing all these other issues that seem like they're unrelated, but they're certainly correlated.
Do you see that happening soon, and would you be an investor in Fannie and Freddie?
I think that I am an investor in Fannie and Freddie because of the loans that they write to us all the time in some regard. I think most importantly, as an investor, if I was really looking at a larger asset allocation, and there's a bunch of hedge fund guys much smarter than me to do that, I think it's actually a tremendous opportunity, because if it was, let's say, an IPO per se, it would be bigger than Saudi Aramco. That's one. Two, it would allow international investors to participate in the American dream. So I think that's really the part that's interesting. If this was a banner and this was, publicity, say, look, how do I participate in the American dream if I'm living in XYZ country? Buy Fannie and Freddie's secondary.
Secondary, not an IPO, as Matt Miller
It is not an IPO. Everyone says
IPO.
Initial public offering, but you can see that the shares, look, right there, they're trading currently, so
there you go. I do want to go back to Austin, because you mentioned
Sure.
that when you're talking about the supply picture. Rents have actually been cooling in Austin.
They have.
You can't say that about many other hot cities in the country right now. How do you approach that as a builder? Is that a market where you would still want to build more? Does that make sense?
Yes, it does. And it absolutely does. In fact, we have close to 1,000 new multis in some level of pre-production now, another 1,000 houses that we're building within the Austin submarket. And I think talking about a city in an isolated setting like Austin is such a big statement. Clearly, New York is a much more exaggerated version of that, but what happens on one block is not what's happening on another block. For example, JP Morgan just opened their $3 billion office tower, and I saw some headlines saying, oh, this is the rebirth of the office market. No, it's a $3 billion tower that was built to suit, that had the tenant already in place. There's no speculation, right? So I think it's about a deal-by-deal basis more than anything. And the thing that concerns me about Austin is actually a more global issue of the $1.2 trillion in loans that were written at 3% that are about to hit a wall over the next 18 months in a 7% interest rate environment. So the reverberations of those type of movements, I think, are going to have effects on cities that aren't directly correlated to the nature of that city itself. Yes, rents have cooled a little bit in Austin, absolutely, but that's tempered by the exuberance that threw them to the roof too high artificially when all the people from COVID started to move in. But the economy as a whole, with the size of Apple's office, Tesla's office, Oracle's office, the deals that are being transacted with Samsung, which is in Taylor, these are battleship movements that just can't be course corrected like a little speedboat.
What people talk about Texas all the time. What about the neighboring sort of sand states, Arizona, Nevada? Where else are you most interested?
Nevada's, I think, a great market. I think Las Vegas is going to continue to grow at an alarming rate. My kids were actually just there recently and went to the Sphere and, saw this, just all the great things that are happening in that city. And I think it's going to continue to grow. That market for us, we haven't participated in it too much other than some self-storage. But in this particular market, I think necessity-based real estate is really where a lot of focus should be. And I think you're going to see a big resurgence in storage, in medical, and contrary to popular belief, the CPI is made up of 35% shelter. And so what we see in housing, and back to that Fannie Freddie discussion, I think are going to have reverberations through the entire economy much bigger than is being reported.
And Phoenix, I
like Phoenix, but I'm biased. We have an incredible site in downtown close to ASU, and we're looking to buy a bunch of other stuff in the opportunity zone throughout the Phoenix market. And to say that it's hot, I think is...
It's literally hot, but also obviously you've got college-age kids flooding in there. You've got retirees flooding in there. So it's really spans the spectrum.
I think you're exactly right.